Hello and welcome everyone. We're just going to give a few more seconds for everyone to join in, and we should be resuming shortly. All right. So good morning, good afternoon, depending on where everybody is logging in from. Welcome again for this webinar, which is titled The African Oil Landscape. My name is Ranjit Raja, and I will be the moderator for today's webinar. Thank you for joining us again, and we are excited to bring the session with some of our in-house experts and one of our privileged guests from Standard Bank. Before I introduce the speakers, there are a few housekeeping points that I would like to cover. At the bottom of the webinar screen, you should see a toolbar. This should give you access to a range of applications, such as speaker biographies, additional resources, and technical support. All applications are resizable and movable, so please feel free to move around the screen in order to get the maximum out of your screen space. We will be accepting questions throughout this webinar, so please submit your questions through the Q&A box, and we will try to get to as many of them as possible towards the end of the webinar. And for a best viewing experience, we recommend closing any programs or browser sessions which are running in the background, as this will help conserve your bandwidth. The webcast is being streamed through your system, and so for the best audio quality, please make sure your computer and the headset volumes are turned up. Some networks might cause the slides to advance more slowly than others, so it is recommended to log off from your VPN to get the best experience. And finally, we do value your feedback a lot, so please do take the time to complete the pop-up survey at the end of the webinar. So without further ado, let me introduce the speakers for today. So we have Ehsan ul Haq, who is the lead analyst with Refinitiv. And he has about 25 years of experience in the crude and refined product market pricing and fundamental analysis. He joined Refinitiv in April last year and has been working on a variety of reports about crude supply, oil stocks, and prices. In addition, he is also responsible for looking at oil flows and fundamentals behind them. The next speaker is Sudarshan Sarathi, who is our senior oil analyst for Middle East and North Africa. And he primarily focuses on oil market fundamentals for the Middle East and North African markets. He and his team generate insights for real-time trading using trade flow analytics and pricing data. Prior to Refinitiv, Sudarshan has been working or was working as a crude oil marketer in global oil markets to metals conglomerate and a refining analyst in one of the largest refining companies in the world. Our guest speaker today is Paul Taylor, who's with the Southern Africa Standard Bank, and he is also responsible for the Standard Bank's oil and gas sector coverage activities for Southern Africa, which spans across 11 different countries, across upstream, midstream, downstream, services, and process industry clients. Paul has 20 years of energy corporate and investment banking experience, covering the oil and gas, power and utilities, and renewables and carbon subsectors, and has been based in Africa for 10 years. Paul has extensive experience in the Southern African energy environment as advisor, banker, and financier. So I'm going to let Paul take the stage and start off with the first part of the webinar.
Good morning, everybody. Just a short introduction from my side to really set the scene from a banker's perspective. It's obviously no secret that we've had the COVID pandemic, and it's obviously no secret as well that the world is probably through the worst at the moment. So just to touch on a few points from an African lens as to what we've seen over the last few weeks and what we expect to see moving forward. So as I speak, Brent is at 41.28, which implicitly says the worst is over. But what are analysts saying, and what are the green shoots from an African perspective? Turning on upstream first, the consensus is fairly clear. Africa has been hit, as with everybody else, by capex cuts. One analyst has the capex reductions of $14 billion this year, over $50 billion over the next 5 years. And the number of oil FIDs have been reduced dramatically to as low potentially as zero. But at the same time, there is not undue pessimism. Projects that have been deferred, for example, Senegal, Mauritania, Ghana, are still expected to go ahead. In the case of Angola, not one of the majors who is in Angola has walked away. Had COVID challenges with production, they've been required to cut costs, but we're already hearing the initial signs that some of the rigs that had been deferred, potentially until 2021, will make it back within 2020. And really the main green shoot, if we have to point on immediate optimism, is the contrarian activities of one of the majors, Total, where having looked to almost step back from Uganda last year and came back in early April, purchased Tullow's stake in entirety, and are very much expected to take FID within the first half of 2021. So upstream, it has been hit badly, but it is expected to come back. In terms of midstream oil, not especially a huge amount of underlying activity in sub-Saharan Africa. The main construction project, the Dangote refinery, is continuing to progress and is expected to enter commercial operations in time. Spending a bit more time on downstream oil, though. It doesn't always get the headlines from a market perspective, but in terms of a banking perspective, banking the underlying African consumer is extremely important. As with the rest of the world, there was a huge demand shock in Africa in the month of April, led by the impact on air travel through kerosene, but also just the sheer impact on petrol, gas oil and gasoline due to reduced mobility. And it's generally seen that Africa has lost roughly about 6 years' demand growth during 2020. But that growth is expected to come back by about 2022. One set of analysts have, notwithstanding COVID this year, Africa at a 2.6% long-term growth projection in downstream products demand, which is only a marginal reduction from the pre-COVID number. And within downstream overall, the most optimistic sector is LPG. LPG, of course, is increasingly a large supplier from the Middle Eastern refineries, from Mont Belvieu and so on in the States, and is increasingly being advocated and encouraged in Africa to be a substitute for charcoal and kerosene and other paraffin, other really unsustainable methods of cooking. And then lastly, to touch briefly on gas, although it's an oil webinar, increasingly, as we all know, the majors are moving towards being energy companies, not just IOC. Gas has been a bit of an outlier during COVID. And as at the end of May, the IEA recently confirmed that the demand for LNG had increased 8.5% year on year throughout the first 5 months, notwithstanding the effects of COVID. And what we're seeing is the implication of that in African gas. So while Senegal, Mauritania is expected to be deferred a little, Rovuma LNG is not going to take FID this month and is expected to take FID next year. On the whole, there has not been any major withdrawal from projects. Some of the largest projects in the continent continue to move forward, the Coral FLNG construction for one, Mozambique LNG to name another. So on the whole, running across the 4 different spaces, the message is really Africa has been affected by COVID. Africa has been affected by the falling crude prices. But as it stands, there have not been project cancellations. There have been FID deferrals. There will be workovers in a reduced capex environment. But we already are starting to see the green shoots of recovery with some M&A in the case of Total, but also the start of rigs moving back in place for future exploration. And I'll stop there. Thank you.
All right, thanks so much, Paul. Thanks for the brief update on the current landscape in terms of the African markets there. So I think next would be our senior analyst, Sudharshan Sarathi, who would be giving a coverage on the North African markets.
Thank you, Ranjit, and thank you, Paul, for the good introduction. Taking on what Paul said about the green shoots seen in prices and Brent being at 41, I think a significant part of that has also come because of the production cuts, both voluntary and involuntary, that we've seen in the last 1-2 months. We've seen exports from the OPEC countries falling significantly, with Saudi and a few other countries having cut more than what they had initially projected. So in all the scheme of things, where does Africa fit in? How much do they contribute to the OPEC? That's a very important thing to address before we move on, because African countries of the OPEC, they contribute close to 15 to 20% of the OPEC's production. That's a significant number. And in terms of exports, they contribute anywhere between 20 to 25% of the total exports from the OPEC nations. So all of the production cuts that are going to take place are going to be impacting the African producers. And if you actually look at it, it's coming at a time when the key markets for African producers are starting to show semblances of a demand starting to pick up. So probably the production cuts are going to take place for the African OPEC members at a time when they should ideally be like targeting those key markets like the Mediterranean market or the European markets. So we spoke about the OPEC plus cuts, but if we look at the compliance from the African member nations, it's not been great. And this was actually a point that got highlighted even in the meeting that happened this month, where they were discussing of a rollover of the phase 1 of the production cuts. And what is pointed out is that most of the countries have not been compliant, and that led to Saudi and others saying that if there is not going to be an increased compliance on the part of nations, then it could jeopardize the whole deal. And that has prompted comments from segments of different countries, including their ministers, saying that they understand the situation and they will be complying more, especially in Nigeria, where the oil minister has come out with a statement saying that by mid of July, they expect to be compliant with the production cuts, and they'll probably even make up for some of the overproduction in the months of May and June. So if you look at the table here, you can see that the compliance varies quite significantly. Somewhere, some people have overproduced, some people have cut, but not in line with the expectations of the overall OPEC plus group. And this, and looking at this right now, if they're going to go ahead and cut more, that could significantly reduce the exports from the region. And like I mentioned, it's just we are starting to see signs of an early pickup and recovery in Europe and Mediterranean, and probably the timing is not going to be favorable for the African producers. So moving on to a major country in the African OPEC space and in terms of the North African market is Libya. So just to give a context, Libya has almost 60% of its GDP getting contributed from the hydrocarbon sector. And Libya contributes about 2.8% of the global crude reserves of crude oil. That's significant, and that's the largest for any African country. Given this, OPEC and Libya had also joined OPEC in 1962, is one of the first African countries to join the group. This shows clearly the importance of the hydrocarbon and especially the crude oil markets for Libya. However, sadly, what has happened is that over the last few years, last decade actually, there have been a lot of infighting in the country, which has led to significant volatility with respect to the exports. It was only when the exports have started picking up in 2019, and suddenly at the start of this year, in the first quarter, we saw that ports getting shut off and pipelines getting turned off. So that has resulted in the exports significantly falling. You can see the chart on the left, and you can see the black line is a 3-month moving average of the exports. And it's a steep fall. The exports fell close to zero, and the very few exports that were there, they came from parts of the western parts of Libya. There were reports in this month which said that the production has restarted And then the next day, we again saw reports that there has been a shut-in of the production again. So if you're a buyer of Libyan crude, there's a lot of volatility, and that's not a good thing if you're a refiner, right? You expect some certainty in terms of your purchases. You don't want to go ahead and buy a cargo and realize a week later that, okay, the production is shut in and there's a force majeure declared. So that's not good for the hydrocarbon industry in the country and the country as a whole, given that 60% of the GDP comes from oil. In terms of the grades that Libya produces, a majority of them, as you can see from the chart on the right, they are light sweet. So the light sweet market is a key driver of how Libyan crude oil will get placed into the market. And given that Libyan production and exports have dropped, this has prompted the key markets like the Mediterranean to start sourcing light sweet from other countries. So I think we'll touch upon that a bit more in the future. If you look at, like what I said, the Mediterranean contributes to a majority of the exports from Libya. And that's kind of understandable considering that the proximity of the market, and Libyan crude has always been like one of the preferred grades that have been picked up by the Mediterranean refiners. However, if you look, APEC, Asia Pacific has also been a key buyer of Libyan crude. And a majority of that comes from China, who's been a key demand center. And at the start of the COVID pandemic, we saw China kind of scaling down imports. That has now been corrected and they've started importing again. But one key aspect for anybody who's tracking Libyan oil to consider is that China, who's contributing significant portions of the Asia Pacific demand, they are also negotiating trade deals with the US, and under which they might be expected to pick up a lot more of US crude oil, which is again light sweet. So it's in direct competition, and that could potentially strain Libyan exports to China and hence into Asia Pacific. So if you're looking at the Libyan market overall, you would want some sort of a stability to come back into the market, because that's when the potential of the country can be fully utilized, given that it's got enough reserves to kind of cater to the markets. The next country that I want to talk about is Algeria. Algeria is, just to give some trivia, Algeria is the largest OPEC country in terms of the area. So that's significant, and it's the second biggest country is Saudi Arabia, so you can imagine the scale of the country's area. In terms of hydrocarbon contribution to the GDP, it's about 20%, which is still significant, not as high as Libya, but it's still significant. But what has sadly happened over the years is Algeria has not been able to attract enough investments into the oil market, into the upstream oil sector. And this has resulted in the production falling through the years. You can see from the chart, it's pretty evident that Algeria, which was exporting close to 1 million barrels a day, at one point of time, the exports have started falling. Over a period of time, it's been a slow fall. And unless there are investments made into the upstream sector, it's possible that they may not be able to ramp up the production significantly. And similar to Libya, if you look at the grades, Algeria produces a lot of light sweet grades, especially which are, they have a high yield of the lighter ends, including naphtha. And this is preferred by people who have a petrochemical downstream integration. And we can actually see that there have been significant volumes of these going towards refiners who have a petrochemical integration. In terms of the key regions, again, just like Libya, the Mediterranean market is the most proximal market and hence gives the best value for the crude. So majority of the volumes go to the Mediterranean market. Northwest Europe, UKC, and Asia. These are other markets which come significantly high in the order for Algerian exports. What is interesting to notice is that we saw China was a key demand center for Libyan crude in Asia. It's India for Algerian crude in Asia when it comes to the exports that get picked up. But in the last quarter, the current quarter of this year, we've seen a slight change. We've seen more volumes going towards South Korea. And like I said earlier, this is because of a start of demand, especially for petrochemicals in China and in South Korea, especially because of the PPE manufacturing due to COVID. And what we've also seen is interesting trade flows. I'll show you with the map here. So these were trade flows that we picked up using the interactive map feature. And you see here that Saudi Aramco's trading arm, which is ATC, they've taken a couple of vessels loading in Algeria. They've topped up the volumes in Yanbu with some Saudi grade, and they've taken it to Onsan in Korea, which is where the Soil's refinery is there. And Saudi Aramco holds a majority stake in the refinery. We need to wait and watch if this is a changing trend where South Korea is going to pick up more Algerian volumes as compared to India, or if it's more a one-time disparity where we see that Indian demand has not been significant and potentially South Korea got these grades at a good bargain. So that needs to be seen in the next few months. And if it is, it shows a significant change in the trade flow pattern. I think Egypt features as a key North African country in terms of oil exports. The production in Egypt has been declining over the years because the emphasis is moved more to gas and less on crude oil because they found significant gas finds in the region. However, Egypt also features as a staging point for crude oil exports from the Middle East into Northwest Europe and to the Mediterranean. So it's an important storage hub. However, they do produce a few grades which catch the interest of both Mediterranean and Asian refiners, especially in the case of Asia. If you can see from the chart, there are a few quarters or a few months where the percentage of imports by Asian refiners is high. And that's because of the spread between Brent and Dubai. So if you look at the grade profile, you can see that most of the grades that get produced in Egypt are SAR, and they are medium to heavy. So if Dubai-linked crudes, like the Middle Eastern crudes, are going to be expensive, or if there is a shortage of supply, it has prompted refiners in Asia, especially in India, to pick up grades such as Raspberry, which can kind of like supplement the lost volumes from Middle East. So this trade flow pattern depends highly on the spread of prices. Otherwise, the majority of the volumes end up going to the Mediterranean. Another key country in the region that I would like to touch upon is South Sudan and Sudan. As a whole, it's a production and export unit. It's a peculiar case actually, where South Sudan has the oil producing fields, and the export infrastructure is with Sudan. And after the civil war and the split between the two countries, the oil producing assets went with South Sudan, and export went with Sudan. And this is a key geopolitical risk. There have been times when export has been stopped because of disagreements between the two countries. However, of late, it's been like pretty good, and they've worked around some solutions. And if that continues to remain in place, there should be exports seen from the country. However, I just wanted to highlight that it's a key risk for the market. In terms of the grades, they produce medium to heavy sweet grades. And why is this important is because of the geography of the country. It's pretty close to the Middle East, and because being from the Red Sea, the voyage time is not very significant to get to Fujairah. And Fujairah, as we know, is a significant bunkering hub. And the prices in Fujairah for LSFO are generally lower than what it is in Singapore. And why does that happen is because of grades like Dar blend, which get shipped out from Sudan, where refiners in Fujairah who have topping units, they're able to extract the bottom ends, which would be your fuel oil and low sulfur fuel oil, at a much better price point because of the voyage time and its proximity. It gives them a significant advantage. And that's visible from the chart. If you can see that the percentage of exports going to the Middle East have actually started climbing up from Q3 of 2019. The IMO regulations, which kind of brought in a change in the sulfur spec of fuel oil, that happened from the 1st of January of this year. But refiners started taking actions right from Q3 of 2019. And this is visible because you can see consistently Middle Eastern importers have increased their share, and now they've gone ahead of Asia Pacific. And that's because any refiner in Asia has to pay up the price that a Middle Eastern refiner is willing to pay. And sometimes it can bid up the prices, which is not favorable for an Asian refiner. And within Middle East, almost all of the volumes in entirety go into UAE, especially to the port of Fujairah, from where it gets picked in by the refiners and made as VLSFO. The last country that I want to talk about is South Africa. Why is South Africa important? It's not an oil producing or an export nation, but here we want to talk about South Africa because it's a key market in terms of the imports of crude oil. It's a refining and storage hub for Africa as a whole, and so we want to talk about that. And if you look at the imports, Middle East used to contribute significantly into the imports into South Africa. However, with the passage of time, we've seen that West African countries have started gaining more market share, and the refineries in South Africa, they generally are equipped to handle the West African grades better. And despite all of this, we see there is a lot of refined product import, especially for ULSD, which happens from the Middle East. So the downstream sector in South Africa probably it's got some opportunities in terms of investments. And given that there is a demand in the continent, I think it's a great area people can look at. I want to end with talking about the opportunities and risks. We've spoken about most of them through the presentation, but the biggest thing that comes to my mind in terms of opportunities is Africa as a continent has a lot of demand which is domestic to the continent. And sadly, what happens is that most of the crude oil gets exported and they end up importing refined products. That is kind of changing with a lot of focus coming into the downstream sector. As Paul mentioned, we've seen Dangote refinery in Nigeria. There's been investments, and hopefully we should see the refinery coming up soon. But still, there's a lot more that can be done in the sector. And for a long term, if you look at the demand for crude oil, the proximal markets, they might have a risk that in Europe or in the Mediterranean regions, due to changing environmental regulations, we could see a decline in demand for transport fuel. And probably African countries have to start looking inwards and invest more on the downstream sector to kind of give the crude oil a home and at the same time cater to the internal demand. And in terms of the risks, I would say that the geopolitical element is very significant, especially for North Africa. I think when stability returns to the region, it will help improve the oil industry and the countries as a whole. With that, I would like to hand over to Ehsan.
Hello, everybody. So I will be talking about the West African market. I'm starting with crude quality, then looking at the whole region as an export hub, then looking at exports of two key countries, Nigeria and Angola, and key importing regions. And at the end, I will talk about the outlook for these grades. So starting with the crude quality, as far as Nigeria is concerned, Nigeria has mainly light sweet grades. Most of them are middle distillate rich. Agena is an exception. Some of them are very, very light, such as Agbami. Then there is a discussion whether it's condensate or crude. Why is it important? Because OPEC doesn't take condensate into consideration when cutting production. So as a result, there has been a lot of discussion about it. Angola, on the other hand, has slightly heavier grades, but with very low sulfur contents. Some of them have high TAN numbers, that means high acidity. They are good in producing very low sulfur fuel oil in line with 2020 bunker fuel oil specification. The rest of West Africa has heavy grades such as Lokele from Cameroon and light grades from such as Kosa from Congo. Most low sulfur grades, most of them are low sulfur grades with the exception of Gabon's Manji, which has around 1% sulfur. In terms of reserve, Nigeria has the second largest proven reserves in Africa after Libya, something around 37 or 38 billion barrels of proven reserves. Angola is the fourth largest in terms of proven reserve. After Libya, Nigeria, Algeria, Angola is the fourth, and with reserves of something around 9 to 10 billion barrels of reserves. So now looking at West African crude market share in terms of exports, the most important one is Nigeria, and then Angola. We have to keep in mind that these countries, some of these countries have very high break-even prices, although some of them might not have high break-even price, but still they need high prices to finance their social services. Refining capacity is limited, although the Dangote group is building a refining in Nigeria with a capacity of 650,000 barrels per day. It should be complete by 2021, according to the company, but analysts doubt that it will be complete before 2022. In terms of exports, most West African crude exports end up in Asia, followed by Europe. Flows to the Americas are falling as the U.S. turns to its own production. It has more than enough light sweet crude, so as a result, it doesn't need so much West African crude. However, the U.S. East Coast still imports some Brent-related crude. Canada also does enough to meet its light sweet crude demand. Latin American producers, sometimes they swap their heavy crude supply with light sweet crudes from West Africa. And recently, Middle East has also imported some heavy sweet crude in order to produce very low sulfur fuel oil. Looking at individual countries' exports, Nigerian exports mostly go to Europe, while the North Sea can meet some of the demand in Northwest Europe. The Med is short in light sweet crudes, especially middle distillate rich grades. Unstable Libyan crude production has also prompted Med refiners to turn to Nigerian crudes. As mentioned earlier, the Middle East has become interested in some low sulfur grades to produce very low sulfur fuel oil. So now looking at individual countries, if we look at Nigeria, and Europe gets most of its Nigerian crude because it's middle distillate rich grade, and most important importers are Netherlands, Italy, and Spain. Spain, which is the largest importer in the region, prefers grades such as Erha and Escravas. These are middle distillate rich grades. And in recent years, what we have also seen is that Agena grade is very popular in Europe. The continent started buying it because of its high introductory discount, and then gradually became addicted to it. Agena is a special kind of grade, and now it's become very popular. Why? Because if you look at yields, it has a very high middle distillate, jet and gas oil yields. Similarly, it has very high fuel. Forget